So, Eric, because of some of our watchers might not know Vext, or maybe because this is the first time you've been on CB1 Five Questions, could you just give a brief overview of Vext business and where you view your specific competitive advantages?
Yeah, Vext, as you mentioned, is based in Arizona, but our big focus has been on Ohio, and we've been working on growth in Ohio. In Arizona, we have the two stores, and we're vertical with cultivation and other assets. I think part of the advantage of Vext is the fact that we never expanded beyond what our capabilities were from a capital standpoint and always stayed focused on the capital and on where the growth opportunities really were. And we built the company that way. So we try to own our assets and we finance a lot of times with those assets under a traditional mortgage standpoint. And I think that's been one of the differentials. And you're seeing it in Arizona where we've been able to exit the cultivation area in Arizona as it's been oversupplied and take advantage of that oversupply and recognize that it's cheaper for us to buy than it is for us to grow. And that gives us that flexibility. Where in Ohio, its market structure is at a different thing and it behaves differently than, say, Arizona. But that's always been what we've always approached is what does the market want to do? And we participate in the market. We're not really going to set the market. And if we keep the structure and the cost right, that gives us that opportunity and that advantage. So to sum up what our advantage is we've been focused on the vertical and being able to control the retail. We see that's really the brand in cannabis, and that's how our margins work, is to have that retail door, be able to supply our own product or purchase product depending where the cost advantage is.
Yeah, I love that, and I appreciate that. I know you wrote a great article for Todd's Substack about where you view the moat in cannabis, which right now is kind of owning the retail doors and owning that consumer pipeline, right? And from a Canadian point of view here, I think one of the largest weaknesses in our market is that we never had the opportunity to own retail. It was completely bifurcated. And a lot of those wholesale brands still haven't necessarily built a real strong, durable business. And I think that's a real testament to how important the retail strategy is, not just from an economic point of view, but also from a market share and a brand control point of view. So I really appreciate that.
Well, if I can follow up on that, Josh, I think you're spot on with that analysis. But what I really think you're indicating is that this is a commodity. And within a commodity, you're not really creating a demand. You're more of converting the demand. So when you start to convert demand, that means that it's really price is what's going to drive it. Branding has something to play with it, but not in this space and not in a commodity. It really is going to be the price that drives that and sets it. So within vertical or anything we're doing, we are extremely cautious and cognitive of what our cost is. And we don't just look at our cost of what cash we've got out, we look at what assets we have tied up and how the capital is deployed.